Okay, Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is real. Look, if there's one takeaway other than a plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly.
All right, guys, so we got to talk about the collapse of woke Silicon Valley Bank. And I mean by woke, this company is woke, okay? And I think that the collapse of this bank, which has been the largest bank failure since the 2008 financial crisis, can teach us a lesson about how so-called diversity, equity, and inclusion does not really help the bottom line. It does not really help a company be able to run its operations efficiently and to return capital to investors, which quite literally, I mean, in this situation right here, this company failed to do that, and this is why they collapsed. But we got to talk about Jim Cramer, okay, who you guys noticed in the first video of this video that this guy has not had a good record when it comes to picking stocks, okay? He's been notoriously bad, right? Terrible. He's also not a good judge of character in people as well, too, apparently.
To me, it's reasonable to compare you, I usually don't do this, to Steve Jobs and what he did for computing. I regard you as a visionary, next-generation person. Is this the kind of ridiculous pressure that nobody needs?
J.P. Morgan of this generation, Sam Bankman-Fried's FTX,
Yes.
is slashing everybody's margin. And average fees per transaction across the industry had declined by 50%. A lot of that is the man, Sam Bankman-Fried.
Yeah, so according to Jim Cramer, proven fraud, Elizabeth Holmes, is Steve Jobs, right? She was the next Steve Jobs, okay? And another basically proven fraud, Sam Bankman-Fried, he was JP Morgan of our generation. This guy also called people who refused to take the experimental vaccine psychotic while pushing for Biden to create more mandates for people to get the shot.
But nobody with any power is saying the frontline workers need to be vaccinated. It's just plain wrong. And most of us are sick of it. Even as a vocal anti-vax minority is always grabbing the mic. This charade must end. The government must require vaccinations, not of this group or that group, not company by company, not cruise ship by cruise ship or airline by airline or governor by governor. The buck stops at the White House. Some of us are old enough to remember when we were told we had to get a needle stuck into our arms because of some disease that was so scary we were afraid to talk about it. But back then, anyone who refused to get vaccinated would get ratted out immediately because we knew that person could hurt other people. The commonweal was a commonweal. Now we're engaged in a similar struggle with COVID, and Eisenhower would be aghast. We have immunocompromised people who are incubators for every variant to come, walking around lawfully unvaccinated. That's psychotic. We have companies that have tried hard to get people vaccinated and now backing down. We have governors who want to be president by grandstanding on a foolish states' right issue, the right to get sick, get other people sick. So it's time to admit that we have to go to war against COVID. Require vaccination universally. Have the military run it. If you don't want to get vaccinated, you better be ready to prove your conscientious objector status in court.
Right, again, terrible judge of character, terrible judge of companies as well, too. And again, boy, oh boy, did he really drop the ball on the collapse of Silicon Valley Bank, which is a tech-focused bank, okay, that primarily serves more higher riskier clients like venture capital firms and startups. Now, this bank collapsed because the Federal Reserve is increasing interest rates, which makes it a lot harder for tech startups, which were the main clients of this bank, to raise money from investors because they're more risk averse because the cost of money is higher. Okay, it costs more money to borrow money to invest, so therefore they want to stay away from high risky ventures. Now, this caused a bank run. Okay, a lot of these tech startups did a bank run on SVB, and SVB did not have the reserves to meet this bank run. And then they were also forced to sell a bond portfolio that they had, okay, at a loss because interest rates were increasing, which decreased the existing value of bonds, right? So interest rates rise, bond prices go down. The bank was forced to sell their portfolio at a loss in order to try to meet some of the liquidity needs of their clients. So they try to raise more capital, and this spooked investors. And you had some venture capital firms basically tell their investors to pull their money out, right? Like, you need to pull your money out because they don't have confidence in this bank who needs money, right? A bank needs more money, right? And they were like, hey, you know what? We don't really like this. And again, that caused basically all the investors, a lot of clients at that bank, to pull their money out, and the bank ended up collapsing, right? And that's what happened. Now, again, in a rising interest rate environment, finance expert, Mr. Jim Cramer, you would think he would have saw this coming. However, he did not see it coming. He actually predicted the exact opposite, that this is a stock that you should actually buy in 2023, literally 1 month before this collapse.
The ninth best performer year to date is SVB Financial. Don't yawn. This company's a merchant bank with a deposit base that Wall Street had been mistakenly concerned about. SVB is the old Silicon Valley Bank. Recently bought one of our favorite research firms, Nathanson, and it's become less dependent upon private equity and venture capitalist offerings. Wait a second. Those dried up last year. They could come back. Yes, some of them come back here, but the stock directly affects an oversold position. Stock was the fourth worst performer in 2022. I think the fears were not justified, and it's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away. Being the banker to these immense pools of capital has always been a very good business. Stock's still cheap. Now, you have to remember that a stock that falls 66%, like SVB Financial did last year, it takes it a lot more to recover. After losing 2/3 of your value, you need a 200% gain to get back to even. This is arithmetic. Some people call it geometry. So you could argue SVB's nearly 40% rally this year is barely a drop in the bucket. And that's how I want you to think it. I think it's also a good example of why these bounce back moves might be far from over. These stocks could have more room to run, especially if you think they were driven down to artificially low levels by tax loss selling, artificial dumping, like we saw.
And yeah, lo and behold, a month later, you have one of the largest financial collapses, again, since the 2008 financial crisis happened.
The second biggest bank collapse in U.S. history just went down. So the bank is called Silicon Valley Bank. It is the de facto bank for founders. In 2019, they had $60 billion of deposits. By the time 2022 rolled around, that went up to $190 billion in deposits, because there's been this huge fundraising boom. Startups have been raising money like crazy. All that money was going into SVB. So SVB has all this new money all of a sudden, and they're like, what do we do with it? They decided to actually buy mortgage-backed securities. That's what kind of was at the heart of the 2008 financial crisis, when those mortgage-backed securities turned out to be a little less safe than people thought. So they put $80 billion in MBSs, mortgage-backed securities, at a yield of 1.5%. What they did not foresee is that rate hikes were coming. At the time that they put that money in MBSs, that 1.5 was doing okay because the federal interest rate was 0. Now it's up to 4.5%. 2 days ago, SVB kind of shocked the world by saying, hey, we're having a bit of a liquidity crunch. We're going to actually sell some of those MBSs and also do a little bit of a capital raise, which spooked people. They're like, wait a second, our bank needs money. They can't cover our deposits. Then all the VCs started telling their founders, SVB might be on thin ice right now. I think it might be best if you pulled your money out of SVB. That kind of created this cycle that played out on Twitter too. So coming up to the news today, the FDIC has actually taken over SVB because it can no longer pay out its balances. So it's the first time that the FDIC has seized control of a bank since 2008. That's why everything's kind of scary right now out there. The entire banking sector is also getting smashed by this because everyone wants to know, well, how are your balance sheets doing? Like, where's your customer deposits tied up in? So banks across the board are down. Stocks are really, really red. It's a really uncertain time right now, but hopefully that's your explainer of what's going on with Silicon Valley Bank.
Yeah, so again, this is a big, big deal. We don't know if this will cause a domino effect, right, throughout the banking community, so to speak, and we get a 2008 style financial collapse. Who knows? Okay, I mean, it could be the start of that, but regardless of, there probably will be some issues in venture capital and private equity for sure, right, with startups because of this collapse. So you could see a lot of startups kind of just cease to exist because of this collapse. Now, what I find really interesting about this bank is that this bank is woke, right? It's in Silicon Valley, and they're super woke. Okay, they're all about diversity, equity, and inclusion. In fact, they actually issued a statement after the George Floyd incident, right? And they talked about how they stand in so much solidarity with the black community. Now, the reason for me bringing this up is that I think this is an example of how diversity, equity, and inclusion cannot save you from the consequences of running a bad business, right? And this is why these companies should focus more on running a good business and hiring the best people possible. In this case, probably not just hiring the best people possible, but also lending to reputable firms or startups that actually have a good business model instead of having a diverse founder, right? So let's read this real quick. We at SVB Private stand in solidarity with the black community in the condemnation of racially motivated violence and discriminatory treatment. The events of the last few weeks are the latest, but by no means the only examples of racism in our communities, and reminds us of our responsibility to be a part of both local and national solutions for social justice. Like our country, our company is made stronger by diversity. Made stronger by diversity. Right. We're committed to ensuring our firm's culture continues to reflect diversity, and our work environments are thoughtfully contemplated to ensure fair and equal opportunities for all colleagues, clients, partners, and neighbors. We also recognize that there is still much work to be done, and are seizing this moment to reflect upon how we can best move forward to both further embrace diversity within our organization and become an effective ally in addressing social justice issues in our communities. Yeah, so they issued this during 2020, right? They should have been more concerned at this point in 2020 about the effect of spending trillions and trillions and trillions of dollars, putting that into the economy, okay, while nobody's working, the possibility of inflation, that interest rates would rise, right? Interest rates might rise one day. Nope, they were more worried about how woke and diverse their workforce was, right? For example, they got this little chart right here where they let you know that, hey, 46% of our workforce are women, right? This is how much women that work in our company, okay? This is all about race. As you can see here, even though they're woke, they still have to employ mostly whites, right? And then Asians as well too. Well, why? Because they're in Silicon Valley, okay? Yeah, and they got 6% black, and then you got like 9% Hispanic, Latinx, okay? Yeah, so this is what they're concerned about here, guys. And again, my question is, what did this do to help or prevent this bank from collapsing? Not a damn thing, right? Not a damn thing. How in the world are you as a bank? You can't manage your finances. You can't manage your liquidity to make sure that you can actually fulfill your obligations if the worst case scenario happens. You can't do that, right? None of the smart people at that firm figured that out, but they figured out how to create a diverse work environment, right? They focused on diversity and inclusion. You figured all that stuff out. You're more worried about George Floyd than you were about the actual business. And this is what happens. This is what happens. You collapse. Everything woke turns to ish. Okay, look what happened with FTX. Woke. The founders woke as hell. Major donor to the Democrat Party and Republicans too, but more so to the Democrat Party. Loves Democrats. Collapse. Right? Again, I'm just saying. This is what happens when you go woke. You go broke. So let me know what you guys think. Make sure you like, comment, and subscribe. Most importantly, share a black conservative perspective. Peace.